We happen to live now in a very exciting time because all four asset categories are undergoing or about to undergo major trend changes. We regard the stock market probably as, the stupidest asset out there in terms of its response to events in reality. If you want a hot market, I think the food markets are where you look, particularly the grains. Our volatility metric, which we've had since the inception of the firm in '92, is based on the bandwidth readings, the standard deviation bandwidth readings of our weekly momentum readings of the S&P. So it's like the Bollinger Bands around momentum, okay, not around price. And we measure the width between those, so they contract and expand with volatility. And it developed a structure, a trend structure that was very clear. It actually broke out on Friday, February 2nd. That was the end of the week prior to the collapse week, which came on Monday and Tuesday the next week. And of course, volatility exploded during the collapse. So we issued a report that weekend saying, okay, we got our signal. We expect volatility to increase rapidly. And obviously that meant would be associated with downside in price. And little did we expect it to be 250 plus points in the S&P in a matter of 48 hours, but that's what happened. And of course, those who shorted volatility were, even some of the ETFs that were associated with that were wiped out overnight. They just shut them down. I got in the business in the future side in 1975 and studied under the head of E.F. Hutton's commodity division, who was also chairman of the COMEX at the time. And that was the year gold was legalized. So I got my feet wet and played the role of a futures broker for 17 years, and I wasn't a very good salesman, so that's what brokers really are. I spent more time analyzing markets than I did selling and playing golf and so forth. The big trade of my life, and the one that caused the emergence of MSA as a research firm, was in 1987 when the crash occurred. The market had persisted on the upside for a very long time. Many people were looking for down, but they couldn't time it. And by using quarterly momentum of the S&P, and we'll get into the methodology in a minute, but it was very clear that there was a massive structure to be broken that wasn't apparent on the price chart, but was apparent on quarterly momentum. And it was broken about a week before the crash occurred. So it gave us enough time and warning. We could see it coming because the structure was there. And the readings were moving toward the breakout point. And it was that event that caused me to decide to evolve out of the futures business and develop a research company, which we did develop finally in 1992. And our client base is high net worth investors and asset managers, registered investment advisors, and so forth. Our primary focus is long-term trend changes in the four major exchange-traded asset categories, which are now global and accessible via ETFs, via futures, many ways to access the four asset categories. And so we look wide. We're very flexible. We've been bullish, we've been bearish on every single market out there. But we don't flip-flop on the short term. We take note sometimes of the short-term events, which are often counter-trend, but our focus is primarily on trend changes that will have some lasting, some duration to them, a year, maybe even a few years. Our methodology is distinctly different from other private technical research firms. While we do include price charts in our reports, they're really secondary to what we do. We take price and, as Bob Farrell said, the famous Merrill Lynch technician, markets tend to return to the mean. That was his number one rule of investing. What we do is we've observed that markets also oscillate the mean, meaning they cross over and above, above and below their moving averages, whether it's a long-term average or short-term, so forth. And the reason we focus on momentum as opposed to price is that we don't trust price because of the units of measurement used to measure price. Specifically, in the area of financial analysis with the fundamental or technical, we use these things here, money units, yen, euros, so forth. And those are very inaccurate, always changing, very much distorted units of measure. Unlike, let's say, for example, a contractor who builds a home or a high-rise or whatever, he has various tools at his disposal in manufacturing the home or the high-rise, units of linear measurement, weight, and so forth. And he trusts that his yardstick, for example, is an accurate, unchanging, objective unit of measure. Because frankly, if it weren't, the houses he built would collapse. The yardstick it says 36 inches, it remains 36 inches. It doesn't expand and still say 36 inches, because if it did, it would be a distorted unit of measure. Well, our units of measure in the markets are expanding all the time. Dollar, for example, has expanded the quantity of dollars via M2 since 1959 has expanded by 4,600%. That's roughly doubling quantity every 10 years. So what that tells you is that your unit of measurement is expanding constantly and is causing, therefore, measurement distortions. And if you look only at price, then you're looking at those distortions. If a stock was trading at $30 5 years ago and it's trading at 30 now, you're not break even. Your unit of measure is decayed dramatically. Therefore, you've lost a lot of real value. Problem is that this monetary expansion and distortion does not move evenly across asset categories. It's like a flow of money that can carve out different channels, different directions. And investors have a lot to say about that. Investor preferences, we've heard that phrase. Investors can choose for a period of time to like stocks more than commodities. Or, for example, between 2000 and 2011, they like commodities more than stocks, vastly more. And these shifts in the river flow, so to speak, are not evenly distributed across asset categories. So you can't simply, let's say, compensate for the money growth by measuring against, let's say, the consumer price index or something like that. It doesn't work. It's a flawed concept. So how do you get around this? Well, you can't really totally get around the issue of the distortion in the money metric. What we do is we measure price in its market price in relation to its mean, as Bob Farrell said. Its return to the mean, its oscillation of the mean. And we create an oscillator. And we plot them in bar chart format, much like you would a price chart. And when we do that, that tends to separate the nominal price, the money unit price, somewhat from the action of the market, because the oscillation of the market is largely determined by itself. One stock might be moving in a volatile manner, one might be dormant, and they'll give you different momentum measurements when you look at them. But by looking at the momentum oscillator, we see trend structures, trend developments that you often do not see in the price chart. Or most often, momentum will tend to lead in a new direction prior to price making it evident that there's a new trend underway. Usually within 3 to 5% of a high or a low, we will be able to ascertain that a major trend change is underway. It'll be evident in the momentum action of the market. And by momentum, we don't mean the simple wet noodle type tools that everybody has on their computer, like MACD or RSI and so forth. We literally plot the bars of the market in relation to various moving averages, long-term down to short-term. And so we have a long-term momentum view, an intermediate, and a short-term of any given market at any given time. And we interface these together in our assessment. We happen to live now in a very exciting time, by the way, I think. In fact, the most exciting time in my career involved with markets, because all four asset categories are undergoing or about to undergo major trend changes. And we think these are linked. We think it began to come undone in the T-Bonds. T-bond futures is what we look at in the U.S. We also watch the German Bunds very closely, Bund futures, and the JGB futures, Japanese government bonds. But in terms of U.S. Debt market, the T-bonds turned down in price, breaking a major annual momentum uptrend line going back about 4 years. They broke it in October of 2016. price then was 166 on the T-bond futures. They're now in the low 140s. January of this year, they broke another structure on annual momentum. In fact, it's so massive that it takes your breath away. When you look at a price chart, you will not see it. In a price chart, you simply see an uptrending pattern of a channel of price action, or lower yields, higher price. In momentum, we have a flat floor. The flat floor goes all the way back at least to 2003. I mean, at least 15 years. It's a perfectly flat floor where all the reaction low readings on annual momentum of T-bonds. And by annual momentum, I mean we are measuring T-bond monthly price action in relation to a 3-year moving average. That floor came out on the close of January this year at a price of 148. We think that's the last support structure in the bonds in price, meaning that the rise in yields, the drop in price is underway big time. It's likely to last a couple of years. Usually annual momentum trends will persist for 3 or more years. We think that the first leg down in T-bonds could take price into the high 120s. Right now we're in the low 140s. If it goes into the high 120s on this next leg, not the final leg, just this next leg, that would take yield on the 30-year bonds up to 4.25%, which is well more than a doubling of yield since they topped in 2016. What's interesting, and again, most people have certain concepts inbred in their mind that they learned in grad school or whatever about economics, that if you have rising rates, that should help your currency. Well, with that logic, we've had sharply rising rates, more sharply rising here than anywhere else in the developed world, that is. Certainly more than Europe and more than Japan. Why isn't the dollar strong if we're having rising rates much more so than they are? Well, the dollar turned down on our metrics, and we could see it coming. Dollar index was trading either side of 100. Its high had been 103 when it closed 2016, open 2017. When it dropped through 99, in the month of May, credibly breaking the 99 level, that's where we went major bearish. And by major bearish, I mean on a price chart, you can't see anything being broken there. It was a non-event, just a pullback. But on an annual momentum oscillator going all the way back to 2004, you broke a 10-year plus 13-year uptrend line on annual momentum that was not otherwise evident on the price chart. But everybody's looking at price, not momentum. But momentum said, no, be bearish. Since then, we've dropped down into the 88s. Right now, the dollar's at 90. It's having a counter-trend rally. We suspect the next support's around 86. And we think there's more to go on the dollar. We think it is, in fact, when you look at a very long-term chart of the dollar going back several decades to the 1980s when it peaked, we think we have entered the third wave down in the major bear market that's been underway since that peak. And it's likely to last a couple of years. We don't have any particular projections as to how low the low will be ultimately, but we do know that it is a fresh downturn. It just broke last May. It's not even a year old. It's already dropped more than 10%, and we suspect it has a lot further to go, regardless of the direction in interest rates. So that popular wisdom of if rates go up, it should help the dollar, well, forget it. We focus on momentum. Let's speak of the developed stock market right now. That would be Europe, Japan, and the U.S. We regard the stock market probably as, the stupidest asset out there in terms of its response to events in reality. It usually is packed full of emotion more than other markets are packed. And I think this is a cultural thing. It's a learned thing that one generation is taught by their parents that to invest means to be in the stock market. Therefore, people feel compelled to only participate in that part of the menu. In fact, the menu is 4 asset categories, but they're focused primarily on stocks all the time, even if stocks aren't doing anything. Right now, stocks are doing something, especially in the U.S. They're going vertical, particularly the tech and internet stocks. Other developed market stock indices, however, have begun to break. The S&P has done some serious damage to itself in that February break, as did the European indexes. The Nikkei is very close. In fact, it's trading around numbers right now that if it's trading there in the second quarter, it's going to blow a lot of support structure on its quarterly momentum charts, which will put it into a down mode. We suspect that will occur. Our focus right now is on the most emotional part of the U.S. market, the leadership components, and that would be the famous FANG stocks, which are at the front end of the NASDAQ 100 index, heavily weighted. and at the front end of the PNQI ETF, the Internet ETF. So we're watching those in particular because those are the leaders, and they're the ones that are most packed with emotion and also most packed with the potential for greatest percent decline, which makes sense because, after all, it's true, we know this through history, that the thing that makes the bubble goes down the worst, down the most. .com went down 89% after it broke. But we tend to think that the impact of higher rates, which stocks have shrugged off so far, they've rationalized it away as, a stronger economy. We think the shock effect of higher rates will finally grab the stock market by its ankles and take it down. Commodity markets have been very interesting. Gold was the very first market to turn up. In fact, it turned up before even the bonds turned down. Gold, by our metrics, turned up in February of 2016 as price moved up through 1140. Right now, gold's either side of 1320. Gold quite often is the leader in the commodity complex. It was back in the 1970s. If you recall, that was a major commodity bull market from the mid-70s through 1980. Took your breath away. While stocks labored sideways to down, gold went from a low of $103 up to $850 in that period of about 4 years. So gold took the leadership. Oil also turned up nicely last year, and since its 2016 low. Copper also had a good move from under 2 to over 3. But the food commodities lay dormant. And right now, one of our, if you want a hot market, I think the food markets are where you look, particularly the grains. They've been the most dormant. They're sound asleep. Their volatility is non-existent, and they're not going to go to zero. And I think basically what grains have done over the last few years is go to what we might call theoretical zero, meaning as close to a zero they're going to get. And the only issue then is, when are they going to turn up? By our metrics, they turned up. They turned up in January and in February. Soybeans were first in January, corn and wheat followed in February with the monthly close that broke out their annual momentum charts to the upside. In fact, there's a wheat chart we can look at. When you look at the wheat chart, you'll see a massive horizontal multi-year rectangular base. You do not see that base on the price chart. In fact, if you look at the price chart now, you're not even sure they've turned up. Momentum is clearly turned up. It's the same kind of base that we see in soybeans and corn. It's quite solid. It jumps off the page at you, so to speak. And that's the way momentum behaves when big moves occur. It'll build a big base or a big top that a 12-year-old child can identify. It doesn't take a scientist to measure it. And when we see something that is very clear, very wide, very large over a protracted period of time, either a topping pattern or bottoming on momentum, we assume there's a big move coming. And right now I assume that in the commodity sector, the food commodities, in particular the grains, are likely to have the fastest and the largest percent gain this year. In fact, our first estimate on the grains is that they're likely to produce a 30 to 40% surge during 2018, which is, some people like to make that kind of money over 3 or 4 years in the stock market. I think you can probably do it in 3 quarters in the grain markets now that they've broken out. Also, the participation now of the food commodities in the commodity complex overall will start to cause commodity metrics and the inflation talk to heat up again, which will help do what? Encourage the bond market to go lower for rates to go up. And I think already you're getting some investor preference shift. Again, that river flow of money has been going into the stock market. Inflation can exist not just in commodities. When you look at an S&P chart, you're seeing inflation. You're seeing the effects of monetary expansion. In fact, Bernanke explicitly stated as one of his goals of his monetary policy to drive stock prices up. He thought it would benefit the spirit and the consumer willingness to spend money, which is what his objective was. So he succeeded. He probably overly succeeded. So once that comes unwound, it should be quite interesting. But it's likely to be the last of the asset categories to make the major shift. We think it began with gold, in mixed part in commodities. Now the grains have joined in. It began in bonds in 2016, more so this year. It began in the dollar in May of last year. And I think we're starting to see the breakage in the developed economy stock markets already, with the exception of the leadership elements, the FANG stocks and so forth. But we're getting 4 asset categories that are changing major trend. I think it's quite exciting. I think the big move it come in pieces. First off, I think the bonds, on a percentage basis, a drop in the bonds doesn't have to be that large on a percentage basis to have a great impact to rates. So in terms of how many points is the T-bond or the German Bunds going to drop, if you measure the percent potential drop, it'll be significant to them, but it won't be, let's say, as significant as the corn, soybean, and wheat rise will be, I think, over the next, during this year. So, and each is in pieces. They're not all occurring simultaneously. So you actually have the opportunity, and of course you should be diversified. It's a good term. And by that I mean in different asset categories and in different trend directions. But grains would be one of the most potent, I think, right now. I think gold will be on its second leg up. And we regard that now to be a price-based function, crossing 1350 on a monthly close. In our view, should launch gold on its next up leg. Its first up leg began in early 2016. That will be a large percent move, I think. The bonds, I think, are primarily a motivator or a wave creator. And that while being short the bonds, unless you're using leverage, won't create as much percent decline as will, let's say, stocks at some point. So I would use the bonds as a leadership indicator of trends in other markets. And obviously they've been leading for a while and stocks still haven't responded, but I think there's a snapping point where stocks will, via their own momentum forms of breakage, indicate that finally they've realized that T-bonds mean business. And at that point the S&P will snap, and I think the NASDAQ 100 will snap more on a percentage basis. This based on our assessment of what it looks like now in terms of the breakage potential, the dimensionality of the market. But also our historical record is that generally that which led the bull market and went into excess will lead the excess on the downside. So once those markets break, the NASDAQ 100 and the PNQI, for example, there's probably greater percentage downside there than there will be in the S&P. Now, there's one area of stocks that we do like a lot, and we're very positive on, and that's the emerging markets. Emerging markets, while U.S. stocks, European stocks went up from 2011 through, all stocks around the world bottomed in 2009 and went up through 2011. But in 2011, we had that changeover where we had a drop in the developed markets because of the European debt crisis. At that point, once that sell-off ended in the S&P and in the DAX and so forth, those indexes turned up and went up big. But the emerging markets didn't. They peaked in 2011 and they went down through 2016 while the developed markets continued upside. So the emerging markets went down with commodities during the same period of time, 2011 when gold peaked, down through 2015 and 16. So emerging markets are very much reflective of the commodity price upturn. And we turned bullish on the EEM, which is the ETF in the United States for the emerging markets, in the close of January last year, 2017. At that point, the price of the EEM was 37. Since then, they've reached up to 52. Right now, they're just below 50. So they've had a huge percent gain. In fact, a much bigger percentage gain in the EEM than in the S&P 500 during the same period of time. So we do like stocks, but we like emerging market stocks because they are correlated historically and fundamentally to commodity price action. And as the commodity indexes and commodity markets are beginning to turn piecemeal, the emerging market reflects that. And because the EEM broke out on annual momentum, not just monthly or quarterly momentum, but on very long term, and broke out only in January of last year, they're still very young. We would expect that uptrend to persist for several years, meaning that it's likely if the developed market indices turn down, which we think they're in the process of doing, some already have, some haven't. But when that process gets underway, there will be a spread relationship that will be quite profitable. We think you could be long 50% of your stock assets long emerging markets, while 50% of your stock assets are short developed markets, preferably U.S. indices, which I think have greater percent decline potential than, for example, Europe. But there's a great spread opportunity there, and it's one you can sleep with at night. I don't think so. I think Mother Nature takes over. We've seen this throughout history. It is an untruth that you can't fight the Fed. You can fight the Fed. If you don't believe that, look at the 2008 bear market. They fought it all the way down, and the market collapsed anyway. We think that once they've created their point of excess, and we think this time the central banks of Japan, Europe, and the U.S. have created such excess, historic excess, in unison, that its unwinding will be so terrific across so many asset categories that if they did try to come back in and use, quote, liquidity to halt a stock decline, that it wouldn't go where they want it to go this time. The last time they did that, we had stocks at very low levels. This time we have stocks at very high levels. If they start to break down, we think investors will direct that river flow of money into commodities, into what they perceive to be the feel-better market. And as stocks start to break, investors start to feel itchy because they know, many investors, sophisticated investors, know the stock market is overpriced, and they hope they can time their exit. Some of them have already made the shift into commodities or have begun to make the shift, and that investor preference will pick up as these events unfold. And therefore, if more liquidity is created, I would argue that it's probably going to flow into the commodity arena, which is exactly where they don't want it to go. So I think the central banks are in real trouble. This is their baby. They created it, and I don't think they can unwind it. I think it's going to unwind itself, and they won't be able to stop it this time. It wouldn't shock me that in 3 to 5 years, some of the central banks that exist in the Western world don't exist anymore. That thinkers in politics and so forth will conclude that this was a bad idea. Let's back our currency with something real. Let's don't do this manipulated money unit stuff anymore. The flight to quality, flight to safety, yeah, that no doubt will occur, but I don't think it'll trend. I don't think it'll persist. I think it'll be fitful. And I think, for example, when we had the 250-point drop in the S&P on Monday and Tuesday, February 5th and 6th, T-Bonds shot up 4 points. Bang. That was a big move for them. It didn't last. Of course, the stock sell-off didn't last. And then bonds said, okay, well, we apparently didn't do our job. We didn't, acting as a Judas goat, so to speak. The bonds are there to topple stocks. They had for a moment, but as soon as stocks turned around, the bonds turned around and went back and made new lows. So I think that ultimately the bonds go down, yields go up, and stocks go down with them, and they'll be in sync. There will be fitful moments of flights to safety, but I think there'll be short-term counter-trend rallies in the bond market, not genuine uptrends, reversals. In the commodity area, it would be long gold, although silver has the distinct potential, technically speaking, to catch up and outpace gold, and I think it will, and usually it does during bull markets. And for the last year, it is not. It slinked back down into a range while gold held near its upper end. So that relationship did not work the last year. But if silver gets above about $18.50, we think it could surge to $25 in a heartbeat. Now, $18.50 is not particularly, that's a couple dollars above the market right now. But that's nowhere near the highs of the last few years, which were, I think, 21. So $18.50 is not going to excite a price chart person. But in our view, you hit $18.50, you're likely to surge to 25 pretty rapidly. It's a pretty big percent move. And that wouldn't be the end of the silver move, but that would be the next leg. So silver looks as a potent, of the precious metals, as a potent leg on the upside could easily unfold there. So we'd be looking at gold, silver as part of the commodity position. Grains is the other part in terms of potential of upside. In the bond market, again, I think treated as a wave maker, not as necessarily a place to be. And again, we're speaking unleveraged now. You can always leverage something and make more money, but unleveraged, I think its potential downside is less than would be the stock market downside. So we're watching now for our next, we're sighting in like a sniper on the NASDAQ 100. And we've got some very specific numbers that will come into play starting second quarter, which is 13 trading days after today. And those numbers are not very far below the market. So I would say the other area of good percentage move is short developed markets with a focus on the NASDAQ 100. And again, balancing that out long the EEM against that. So a stock market neutral position. And in the currencies, you can either be short the dollar, long the euro. It's probably 6 of one, half dozen of the other in terms of percentage gain. There are vehicles, of course, for that are leveraged and unleveraged. So there's plenty on the menu out there, and they all interrelate with each other. And at some point, I think later this year, most investors will sit down and say, aha, they all make sense now. The linkages make sense. Right now, I still think we're in confusion right now, I think, with most investors and most analysts. They can't quite put the pieces together, but I think they will later this year.